The US Justice Department plans to ask a federal judge to make Google sell its Chrome browser. As a result, Google's stock immediately dropped by 7%. The question now is whether the stock will continue to fall or bounce back towards $200. We saw Google's biggest single-day drop since January, wiping out a staggering $120 billion in market value and pushing Alphabet back to around the $2 trillion mark. But here's why I always preach to zoom out and look at the bigger picture. Right now, Google's been trading in a consolidation pattern since hitting its all-time high of roughly $191 in July. This recent 7% drop is actually within this range. The stock's hovering around the 200-day moving average, which could act as a solid support level that could push the stock price up. Now, if it breaks through that 200-day moving average, we might see the stock retreat to September's low. That's the next key support level to watch. If it holds, it could do what the 200-day simple moving average failed to do and be the springboard for the next bull rally. But if the stock breaks below September's low, that's when investors need to start taking measures and managing their positions. We could be looking at a far deeper pullback all the way to the psychological $100 level. But that's not a concern for now. Instead, let's put this consolidation in perspective. Before the sideways action started, Google had climbed about 38%. And if we look back further to the 2022 low, we're talking about a 130% gain. So seeing the stock take a breather and form a base isn't exactly shocking. It's actually pretty normal. Stocks naturally need to digest their gains. Here's something crucial I've learned over years of trading. These swings inside a sideways market, they happen all the time, triggered by all sorts of news. I don't get wrapped up in what causes these swings as long as the stock stays within its consolidation pattern, because we could easily see Google bounce right back up from the 200-day moving average, especially with the broader market showing strength. Speaking of market strength, let's look at what's happening in the broader tech sector. Despite concerns about high interest rates and inflation, tech stocks have shown a remarkable resilience. The Nasdaq is pushing towards record highs, and AI-focused companies are leading the charge. Google, with its deep AI investments and massive cash reserves, is well positioned to capitalize on these trends. What really catches my attention is Google's cloud division. In Q3, they reported a 35% year-over-year growth, reaching $11.4 billion in revenue. More importantly, they turned a profit of almost $2 billion, up from just $266 million last year. This is huge because it shows Google isn't just growing, it's growing profitably in a highly competitive space. Have you noticed how the major indices are pushing to new all-time highs? Many stocks are already leading the charge, setting record highs through November. This broader market strength shouldn't be ignored. Here's a little insider technique to my approach. I program my scanner to alert me when stocks break out of consolidation. This saves me from obsessing over daily movements of a stock, and it only needs to be brought to my attention once specific criteria are met. And looking at Google's history, patience has been incredibly rewarding. The 6-month sideways market in 2020, that led to a nearly 100% climb. Another 6-month consolidation in 2023, an 80% rally followed. Right now, we're about 5 months into this current consolidation. Could we be seeing another 6-month base building period before the next major uptrend? Unless Google breaks through September's low, we must side with a base forming before the next uptrend, because the odds are always with a trend continuation rather than a reversal, particularly with the broader market pushing up. Different stocks move at different speeds as a bull run unfolds, and Google could be one of the slower stocks to break out from consolidation, which could be delayed further with this news surrounding the DoJ. This is where patience comes in, and why I don't focus on brand names. I focus on the chart, and why my portfolio has a plethora of stocks which does not include Google for now. One thing that of course intrigues me about Google's future is their AI integration strategy. Their AI overviews in search now reach over 1 billion monthly users. That's incredible scale, and it shows they're successfully integrating AI into their core products without disrupting what works. Now, before we get into what 2025 could look like, let's first talk about why Google stock has been in this 5-month lull. Beyond the Chrome browser issues, there are several factors at play. The company is facing increased regulatory scrutiny, with the European Commission launching a Digital Markets Act investigation in October. We're also seeing investors rotate out of tech stocks, and the AI revolution has intensified competition, especially from companies like OpenAI. The regulatory challenges are particularly interesting. The potential forced sale of Chrome isn't just about a browser, it's about Google's entire ecosystem. Chrome gives Google valuable user data and default search positioning. But here's the thing, Google's strength isn't just in Chrome. Their search algorithm, YouTube platform, and cloud services are massive revenue generators on their own. Even Google's impressive Q3 earnings haven't been enough to break this consolidation pattern. We're talking about $88 billion in revenue, up 15% year over year, and $26 billion in net income. The stock gapped up 6.5% on the news, but did little else and has since settled back into its sideways movement. Now, looking ahead to 2025, Google's got some exciting initiatives in the pipeline. They're planning to integrate their Gemini AI model across products, expand cloud computing through a partnership with NVIDIA, and commercialize Project Starline with HP. They're also pushing hard on sustainability, aiming for plastic-free packaging by 2025. The NVIDIA partnership is particularly noteworthy. By integrating NVIDIA's Blackwell technology into Google Cloud, they're positioning themselves at the forefront of AI infrastructure. This could be a game changer for their cloud business, which is already showing strong growth. Now, YouTube's performance deserves special mention. Ad revenue rose 12% to around $9 billion, with total ads and subscription revenues surpassing $50 billion over the past 4 quarters. This shows Google's ability to monetize different platforms effectively, even in a challenging advertising environment. So, what's an investor like you and me to do? I see 3 potential entry strategies. First, you could buy when Google shows momentum from the 200-day moving average. This gets you in early for maximum profit potential, but it's riskier because if more negative news hits, it could drop below the 200-day moving average. Second, wait for a break above November's high. Less risky, but you might get stuck if the stock hits resistance at the all-time high, keeping you stuck in the sideways market for the foreseeable future. This will be frustrating as you see your risk tied up for little growth, but if you're willing to sit this out and wait for the breakout, you will see good returns. The third option is my preferred option. Wait for a confirmed break above the all-time high. You'll enter later, but you'll have more confidence riding the trend towards $200 and beyond. But here's the secret sauce: compounding. Buy more as Google pushes higher, and you'll create exponential returns in your portfolio. This strategy makes up for waiting to enter at better setups. The key is to strategically add to your position as the trend keeps moving up. But as you remove risk on your previous position, you'll be adding more stock into your portfolio without adding any more risk into your portfolio. Smart, right? Now, I mentioned this earlier, but I'm going to say it again as I regularly see people make this mistake. Successful investors don't get emotionally attached to brand names. They focus on growth, regardless of which stock delivers it. If I open up my portfolio to you, there is a high chance that you will have not heard of a good few of those companies in my portfolio. And that includes me. Some of these stocks I discovered for the first time thanks to my scanner. And these are powerhouse stocks that have been floating for decades and made some serious numbers for their investors. Palantir is a strong stock that I identified early using my scanners and is now showing signs of a potential long-term upward trend. it has surpassed its previous record highs, aiming for that target of $100. Check out this video where I discuss how Palantir might experience a price surge as it plans to move its listing to the Nasdaq.